Hi, everybody. My name is Sam Chaplin. Today is February 16th, 2023. We're coming to you with our halftime report for the first quarter here. You might have noticed in the past, we usually release our commentaries towards the end of the beginning of the quarter, rather. But we're now doing written commentaries at the beginning of the quarter, and then these halftime reports halfway through. Keep you updated on what's happening in the markets. As always, I am joined by our Chief Investment Officer and Founder, James Bradley.
As always, I'm happy to be with you, Sam.
Great. So I'm going to try to keep it short and concise for you here as we can, but there's a lot going on in the market, so we will do our best to keep it moving. On agenda here, we're going to look at the economy, we're going to look at what's going on in the markets, and we're going to look at our general outlook that we're having from our PFA Investment Committee research. First off, the biggest thing to notice, and as I'm sure most of you have noticed now, is this balancing act going on for the Federal Reserve, trying to balance economic growth and price stability. We had a lot of inflation over the past since the beginning of 2022, really, as we'll take a look at. And the Federal Reserve is trying to balance between keeping prices stable, hiking interest rates enough so that it quells enough demand, that demand slows down and isn't causing as much inflation. But the problem is if you hike interest rates too much, now you're going to slow the economy to the point of recession. So they're just trying to balance that act of, high enough interest rates to quell inflation without being so high that growth gets slammed. So on the next slide here, we can take a look at GDP growth. We did have those two negative quarters in the middle of 2022, which had a lot of people talking about a technical recession, which is technically the term. We'll take a look at some of the other recession indicators and see how those are looking. But we did return to positive GDP growth in the last two quarters, in the Q4 of 22 and last two quarters 22, and about 3% gains there, which is pretty typical for trendline GDP growth. Hard to tell on this chart because those two massive swings during COVID really blow up the scale on this whole chart and you can't tell what's going on anymore. But pretty average growth in the last couple of quarters. So before we jump into what's happening in this inflation cycle, we wanted to give you a rundown of what a typical inflation playbook looks like, what typically happens, and we can then compare and contrast how this cycle is the same or different from previous inflation cycles. So this is pretty simplified, but on a long enough timeline in inflation, this is what generally happens. So we're seeing inflation in the economy. There's too much demand for not enough supply. That's causing prices to rise. The Federal Reserve has a tool to try to quell demand. They can't do anything about the supply side, but they can try to quell demand by raising interest rates. And then you can think of how much mortgage rates have gone up, credit card rates, personal loans, any of that stuff. And as those interest rates come up, businesses and consumers spend less money, and that helps balance the supply and demand imbalance. So that's the first thing that happened, and we have seen that happen. Next, what typically happens is companies start downsizing their workforce. Those companies are now faced with higher cost of borrowing. They're also seeing a slowing economy because of those higher interest rates, so their revenues are likely to go down in the future. So they start hunkering down for a recession. One of the ways they do that is by going from a really kind of expansionary workforce to one that's more scaled down for the economy that they're expecting to be in. After that, consumer spending declines typically. So some people are being laid off, which slows consumer spending. Some people are seeing other people being laid off, and they start to worry about their job security, and they cut back on their spending. So those first, the companies usually slow their spending and demand, and then the consumers. After that, eventually, the Fed has hiked interest rates so much that people are starting to have growth concerns. Now are those interest rates so high that it's going to put us into recession, and as the economic growth starts to slow, they turn around and cut those interest rates. Historically, they typically do cause a recession from those interest rates and have to cut them to kind of overcorrect for those interest rates slowing the economy so much. So that's what typically happens in an inflation playbook. We've seen some of this, and some of it has not been playing out as expected. So I'm going to kick it over to Jim. First, talk about inflation and interest rates.
Right. So relative to that playbook, where exactly are we? And looking at, this slide, where if you look at the bottom, you're seeing how, interest rates came way down during the beginning of the pandemic, and that they've crept back up from a Fed funds rate standpoint to offset some of the inflation. And up top, you see what that's done. So the increasing interest rates clearly over the recent period have resulted in a decline in that inflation line, but which is good, but you can also kind of see pretty plainly that that decline has kind of flattened more recently. And I'm sure the Fed is looking at that. And go into the next slide here, you can kind of get a sense as to what's going on behind that flattening? We see that goods disinflation, in other words, the stopping of those price increases of goods that you buy, whether it's lumber or groceries or appliances or what have you, those have kind of come back down to, I'd say, long-term normal levels as far as their price growth, and the Fed has made remark of that. But the blue line here, that's the CPI services less energy services, and basically, what they call the services number. And that's clearly not coming down. That's still on its way up. So the prices people are paying for goods is slowing. The prices that people pay for services is still problematic. And we think you're going to see the Fed be very stubborn in how they handle that when they're looking at it. If we look at the jobs numbers on this graph, that's another thing that the Fed is keeping its eye on. They want to control inflation, but not at the risk of big damage to the economy. They'd like to keep people employed if possible. Well, that doesn't seem to be a problem. Unemployment has declined. It continues to decline. And we had a breakout jobs number a week or so ago that showed unemployment that really kind of record lows. It's right now at 3.4%, lowest we've seen in most of our lifetimes, and yet job openings remain pretty high. We still have a situation that we've been dealing with for well over a year now, where the number of people looking for jobs is half as many as the jobs that are open out there. So the Fed probably is not going to be worried too much about continuing to raise those interest rates to fight inflation, because they're not putting us immediately into a jobs problem. And when we look at the consumer, they're doing their part in keeping the economy going right now. It's very difficult to make the case for us being in a recession right now when, again, jobless numbers are so low. The consumer is still out there spending. One thing that's notable is that a lot of that spending, and notable and maybe a little bit troubling, that a lot of that spending is going on credit. That could be a result of the higher prices that people are paying for the same goods and services that they purchased, a couple of years ago. And so while we, see retail sales continue to climb, a lot of that's going on to onto consumer credit, and that's perhaps a little bit of an indication that a lot of the stimulus money that got put onto the economy has actually started to dry up. Sam, I'm going to throw it over to you, and why don't we talk a little bit about the markets?
Yeah. So what are the markets supposed to do? We got this, counterintuitive issue where inflation's coming down, but the economy still remains really hot between the consumer spending and the jobs employment. So it's hard for the Fed to let off the interest rates while the economy remains hot. And really, that volatility in interest rates expectations has what's been driving a lot of the market performance recently. You can see here on top, the 10-year Treasury rate going up pretty significantly since the beginning of 2022. And on the bottom, a really inverse relationship with the US bond index actually having its worst year since inception of that index last year, hitting a low of down 16.82%, rebounding a little bit over the last few months, but really poor year for the bond markets. But it's breeding a lot of new opportunity where there's some really attractive interest rates out there now for people who are willing to buy them. And it's making fixed income a more appropriate alternative for equities. Last year, we were saying bonds were going to get hammered, so there was no alternative to equities. This year, you can get an investment grade bond at 5%, which is a pretty good alternative to equities. Moving over to the equity performance, U.S. stock performance on here, we got the Dow Jones on top, S&P 500 in the middle, and the NASDAQ on the bottom. A couple of things to point out here is one, not all indexes are created equal. Depending on which one of these indexes you're following, there was wildly different returns in the bond market, or in the stock market last year. The one on the top there, the Dow Jones, tends to lean more towards value-oriented companies, which are less interest rate sensitive, things like the healthcare sector and financials and industrials. We're down there on the bottom, the NASDAQ, it leans more towards interest rate sensitive companies like technology. S&P 500 there in the middle is the broadest gauge of all of these. So the best representation of how the whole market did, down 13.22% at the moment after being down over 20% at the bottoms. Looking at valuation, so that's how things have gone. But as investors, we're not concerned with what's happened in the past. We're concerned with how things look for the future. So when you're looking at valuations here, it's a lot of information on this chart, but what you really need to take a look at is that the forward PE multiple of the S&P 500 is currently a little bit over the 25-year average. We're on much better footing at the start of 23 than we were at the start of 22, when you can see the valuations were way up there, almost on par with the tech bubble back in 2000, and that has corrected a lot. So that is good. If you're a long-term investor, it's a significantly better entry point now than it was at the beginning of 2022. That said, stocks are not cheap by any means. Like I said, still a little bit over the average valuations, and there's 6 different measures of valuations there, and it's showing us as slightly overvalued on 5 of them. And those are all within 1 standard deviation difference, so it's not a massive worry, but I think the takeaway is stocks still aren't cheap. But big question too is when you're looking at long-term averages, we're looking at the last 25 years and looking at how valuations compare. The question is the next 25 years going to look similar to this past 25 years? If the next 25 years we're going to be in a higher inflation, higher interest rate environment, then comparing against the last 25 years isn't very useful. So there's a lot of questions going on of, is this a complete regime change where things are going to be different from here on out, or is this a blip and things will go back to normal? So that is the stock market valuations. Jim's going to talk about some key risks in 2023.
Yeah,
I get to do the opportunities.
Oh, go ahead. Yeah, no, we'll look at the risks and opportunities as we're looking forward. I get the risks. So basically, there's 4 major risk categories that we're watching closely. Interest rate volatility, certainly, as the markets try to kind of suss out where the Fed is going, at what point they're going to stop their increases, at what point they may even be forced to kind of move in the other direction. That's going to cause some ongoing volatility, which will cause volatility in things like bond prices and in the markets in general, we think. An energy price spike, whether it be because of some, just correction to where supply and demand is, or whether it be because of an exogenous shock, the likes of which we've seen in Ukraine, are things that we want to watch too. We've been benefiting from a downturn in energy prices, and that's helped out quite a bit. Do we keep in that direction, or does it bounce back up? An inflation resurgence is always a, this isn't the first time around this for the Federal Open Market Committee. What they've found in the past is they'll look like they've stamped out the flames as far as inflation goes, but then they'll get another flare up, and they don't want that flare up to happen, and they're willing to throw more shade on the market in order to keep that from happening by way of larger interest rates and by decreasing their balance sheet. And so we want to be careful, especially when we see what we saw on the services side about any kind of pickup in inflation, and then just any manner of different geopolitical things that could either calm down and help the market a lot, or that could get worse and hurt the market, whether we're talking about Russia, Ukraine, whether we're talking about China, Taiwan, whether we're talking about China-US relationships. All of these have, probably some degree of impact on where we go economically and as a market coming up. So those are the risks we're looking at. Sam will tell you about where we think there's some opportunities.
Yeah, thanks, Jim. I think the geopolitics especially will be a big factor over at the longer term. A lot of people seeing that how fragile our supply chains were in the pandemic, and that we might need to be more self-reliant, into that rising tensions with some of these trading partners could lead to some deglobalization, which actually could create inflationary pressures over the long term and higher interest rates. So be interesting to see how that works out. Areas of opportunity. It's not all bad. Any crisis brings opportunity, right? we're looking at U.S. value stocks. They've been looking cheaply valued for quite some time now. They're also less sensitive to interest rates, which is helpful in this environment. So based on those two things, we think the value outperformance that we've seen over the past year will continue as long as interest rates and inflation remains high. Next would be international stocks, which also tend to be more value orientated and also have started out with much cheaper valuations. All the momentum's really been on the US side. A lot of these international countries, particularly in Europe, have suffered from slow growth, negative interest rates, poor trading outcomes. And we've seen a lot of that reverse where they're now in positive interest rate territory. Growth is actually much better than was anticipated. And so this might actually be the catalyst to see some international market outperformance, which again, we saw some at the tail end of last year, and we think could have some legs to continue throughout this year. And finally, investment grade bonds. As I mentioned, the past decade or so, bonds haven't been that interesting. Very low interest rates. You used to get maybe 1 or 2% on investment grade bond, and now you can get 4 or 5%. And that makes it a strong alternative to equities for those seeking safety. We don't think interest rates will go significantly higher from here. So we see this as a good opportunity to capture some of those higher yields and lock in some income for the coming years. And with that, we will let you go. Appreciate
Thanks
you
a lot,
being on with me, Jim.
What's that?
So thanks for coming on with me as always, and tell everybody if you have any questions or anything, feel free to drop them in the comments. We'll try to get back to you. We also publish other content on LinkedIn and more content on YouTube. So give us a like and a follow, and hopefully we'll see you next quarter.
We'll see you at the halfway point next quarter. Thanks a lot, guys.
The foregoing content reflects the opinions of Penobscot Financial Advisors and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be construed as investment advice or a recommendation regarding the purchase or sale of any security. There is no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct.